I decided to start a new challenge. I've created a new portfolio, a $100,000 portfolio. Currently, it has 69% in cash. I promise you this was not done on purpose. I already added 5 positions to that portfolio. Now, the goal of the portfolio is obviously to beat the market, but there are a couple of rules. Number 1, the budget is $100,000. Number 2, no extra cash will ever be added to that portfolio. If somehow we lose it all, that's it. Number 3, long positions only, options is allowed, trading is allowed as well. Every type of company is allowed to enter that portfolio. So of course, if you've got any great companies you want me to look into that might or might not be entering the portfolio, as always, leave it down in the comment section below. Oh, and of course, I'll do these updates every 2 weeks. Now, it is very important for you to know that every trade that I made inside that portfolio, you can track it. I cannot delete it. I cannot modify it. If I make money, you will see it. If I lose money, you will see it as well. Everything is tracked. Even things that I add to my watch list is tracked. As you can see here, history, I added Build-A-Bear, Meta, and a couple of other companies on the watch list. And so company number 1 is the number 2 position in the portfolio, of course, after the 69% of cash, and that's PayPal. As you can see, I added PayPal here on February 20th for the price of $58.67. It is now 11.77% of the portfolio. Why did I add PayPal? Well, if you're new to this channel, then I'll just explain in short. If you're not new to the channel, then you've probably already seen the countless of videos where I said that it's just a no-brainer, risk-reward-wise. I think it's still one of the best picks out there. But in short, $63.4 billion in market cap, forward PE of just 11.5 times compared to its, 9-year mean of 30.8 times. Of course, previously, more growth, better margins, more on that in just a second. EV to EBITDA, 8.4 times, price to sales, just 2 times, price to free cash flow in the last 12 months, 15 times, and then the PEG here is at 1.56, which in my opinion is quite low. Not only do I expect the business to start reaccelerating, I also expect them to buy back more shares. And so as you can see here, the last 10 years or so, shares outstanding have come down close to 12%. Free cash flow per share has gone up as well. Me as a shareholder right now will definitely benefit from more and more buybacks in the future. Now, when we look at PayPal, this is on Seeking Alpha. There's a link down in the description if you want to help me out and help yourself out with some discounts. As always, I appreciate that. Now, if we look at PayPal from a profitability standpoint, compare it to the sector and the difference there, we can see that as for gross profit margin, it got a D+. It sits right now at 39.59% in the trailing 12 months compared to the sector median of 59.62. So quite a big difference here and not on the positive side. If you look at PayPal's 5-year average, it's closer to 45%. So you see, that's one of the main issues with PayPal right now is definitely margin profile, not as good as before. If we look at the valuation, still very, very cheap, even though it gets a C grade here. That's just because the sector median sits a bit lower. And if we look at PayPal's 5-year average, PE non-GAAP, 37, PE non-GAAP in the forward one, close to 34. So in my opinion, it should have maybe gotten a better grade here. But overall, if you look at the PEG gap, this is trailing 12 months, 0.18 compared to the sector median of 0.39. Pretty big difference there. Same with EV to sales. In my opinion, still a bargain. Now, it is true that if we look at their peers, right, the likes of Adyen or Block, we've covered Block this week with their earnings report. Stock reacted quite positively. Some people are saying, oh, this is exactly what PayPal was not doing, not great guidance, etc., etc. True, but remember, Block has been a growth company for quite a while. For them to actually give us better guidance, they only had to cut costs. A bit like what Meta has been doing, right? Meta was a growth company, they just had to cut costs, and then suddenly the sentiment has changed. With PayPal, cutting costs right now is just not enough because there needs to be a change in the core business. which is why we have seen transaction margin and transaction expense rate going into the wrong direction for quite a couple of quarters. Yes, it is true that in the latest quarter, transaction margin came in a bit better, but right now it does seem like this is a one-time thing, or at least for the short term. In the longer term, yes, I fully expect transaction margins to go back up. If it doesn't go back up, then of course, the major part of this thesis here is quite broken. And no, for those of you that are asking, aren't you scared that this number of active accounts have been coming down? No, I was fully expecting this. Of course, if this continues for a longer period of time, yes, this will be worrisome, but they are now focused on quality rather than quantity. During the pandemic era, during the growth era, let's say this company was willing to spend a lot more money to acquire a lot of customers, but the thing is, they acquired a lot of customers that are not valuable for them. And so it is costing them money, which is obviously not a good thing. But if you look at the other metrics, number of payment transactions, that has gone up. Payment transactions per active account has come up as well. Now, of course, I can go on and explain the full thesis, but for that, you can go watch the other videos. Right now, I added PayPal as the second biggest position in that portfolio after the cash position, and I will add accordingly, or completely sell out if in the next 2 quarters I see 0 improvements. So far, so good. Then up next, position number 3 is, believe it or not, Google or Alphabet. You might have seen my latest video about Alphabet, about it maybe not being a member of the Magnificent Seven for much longer. If you didn't, I highly suggest you go watch that as well. I know right now there's a lot of noise, and rightfully so, with regards to Alphabet. I mean, since ChatGPT came out, it's been a fake presentation, a failed presentation, Gemini making up history as it goes. I mean, I can go on and on and on. It is true, but there's much more to this story than just fancy schmancy headlines. So, right now, Alphabet, I added shares on February 20th. I added 50 shares at $141.43. It is now 7.15% of the portfolio. With regards to Alphabet, currently has a market cap of just under $1.8 trillion, has a forward PE of just 21.4 times, EV to EBITDA 12.3 times, price to sales 5.2 times, price to free cash flow just under 26 times, and then a PEG ratio here of 1.52. If you watch the other video, you can see that this is the cheapest out there. When we compare it to Microsoft, when we compare it to the likes of Meta, for example, it is much cheaper. The reason for that is that, well, going forward, what happens with Google's, Alphabet's most dominant business, right? The advertising side of things. Search, their dominance in search. Is this going to continue in the future, or are AI agents, chatbots, other competitors out there, ChatGPT, Bing, Perplexity, etc., are they going to take Google's business? Is Google itself going to cannibalize its own cash cow? All of those questions will probably be answered in the quarters and years ahead. But right now, I see no reason why I wouldn't hold Google in that portfolio. If we go back here on Seeking Alpha, we can see from a profitability standpoint, it gets an A+. If we look at gross profit margin, EBIT margin, EBITDA margin, net income margin, all A+, A-, A, great grades. If we look at growth, it gets an overall B. Why is that? If we look at revenue growth year over year, it's a B+, 8.68%, sector median 2.66%. But if you look at Google's 5-year average, it sits a bit closer to 19%. So quite a big difference there. But overall, if you look at growth, if you look at profitability, things are looking quite good. If we look at valuation, it got a D. Why is that? Because if you look at PE non-GAAP trailing 12 months and non-GAAP forward PE, 24.82 and 21.28 respectively. If you look at the sector median, it is much lower, an 80 and a 39% difference to the sector. But to me, if we look at Google's 5-year average, it is a bit cheaper. So valuation-wise, to me, a D is a bit harsh. We'll probably give it a B as well. And again, looking at the numbers here, looking at their financials and not at the headlines. It's true that maybe in the future the headlines will be reflected in the results. But right now, I mean, this company is generating $86.3 billion in revenue, from which 23.69 are income from operations. Like I said, majority of its revenue is coming from Google advertising, and all of its profits are coming from Google services, which is basically Google advertising plus Google subscription platforms and devices. And yes, with Google moving forward, I still expect them to buy back quite a lot of shares, and maybe in the future they might do a meta and suddenly announce a dividend as well to reward the shareholders. But the most important part for me is, can Google fight for the next age of discovery, the next age of search? So far, I see no indication that the competition, the ChatGPTs, the Bing, the Perplexities, the AI agents, etc., are putting a dent in their monopoly business. If that changes, of course, the whole thesis changes. But so far, I haven't seen anything change. Moving on to company number 3, the number 3 position in the portfolio currently, and that's a company I talked about also not so long ago. That company is called Adobe. Now with Adobe, of course, a lot of things can change in the coming weeks because Adobe is reporting their quarterly earnings, I believe, in a week or two. Right now, Adobe, I bought shares at $534.52, only 10 shares. It is 5.5% of the portfolio. Now, I don't know if you remember or if you watched that video, but Adobe did go down. Its stock did crash 7% after OpenAI came out with OpenAI Sora, text to video. Incredible technology, but in my opinion, that's not a reason for a company like Adobe, very stable, huge compounder, to go down 7%. AI is nothing new for a company like Adobe. Now, if you look at Adobe as a company right now, a stock, $250 billion market cap, 30.9 times forward PE, yes, it's a bit more expensive than the others. It's a bit lower than its 10-year mean of 34.7 times. EV to EBITDA 23 times. Price to sales is actually a bit more expensive right now at 11.6 times. Price to free cash flow, that's in the last 12 months, a bit closer to the 10-year mean here at 36 times. A PEG ratio, true, a bit expensive, but that's why I allocate it accordingly, just under 3. If we look at its share outstanding throughout the years, they have been buying back their own shares and actually have been buying back aggressively in the last couple of years. Free cash flow per share has exploded. Remember, previously the old Adobe did not have a subscription model. The moment they switched to a subscription model, the whole thesis, the whole story changed for them and obviously for the shareholders. And right now, as you can see, the majority of their revenue comes from subscription, then a small part from product and services. Now, with regards to the latest quarter, this was quite a while ago right now. The company achieved the first $5 billion revenue quarter with exiting RPO, remaining performance obligations, of over $17 billion. Adobe drove record revenue of $19.41 billion in fiscal year 2023 and 17% year-over-year EPS growth, with strong momentum across Creative Cloud, Document Cloud, and Experience Cloud. Adobe's strategy, category leadership, groundbreaking innovation, exceptional talent, and global customer base position us well for 2024 and beyond. Again, if you want to learn more about Adobe, I highly suggest you go watch the Adobe video in the top right corner. But the main reason why I added this company in the portfolio is, one, the stock took a hit. Right now, I don't see why the business should be taking a hit. Two, I do still think that AI will be a huge tailwind for them. Remember, Adobe has the distribution. Adobe has the name, the recognition, right? If you're a creator, if you're dealing with video, pictures, documents, you name it, Adobe is the way to go. So let's say, yes, Sora came out, text to video. Remember, there was Midjourney, there was DALL-E 2, etc. What happened next? Adobe Firefly came to play. And then, well, people started using Adobe Firefly. Why? Because Adobe has the distribution. Adobe has the millions and millions of people subscribing to their services. And so whenever a great product launches from a competitor, from an up-and-coming startup, etc., if it has to do with creative stuff, it has to do with documents, and Adobe thinks it's a threat, okay, let's build it ourselves. Maybe they are already building it themselves. And then let's ship it to the millions and millions of members. Distribution is key. Then looking at profitability, growth, and valuation, profitability gets an A+, gross profit margin 87.87%, huge difference with the sector median and about the same as their 5-year average. All the others here, EBIT margin, EBITDA margin, net income margin, all A+. When it comes to profitability, really no issues. If we look at growth, we get a B. Revenue growth, 10%, B-. Why is that? Well, first of all, sector median just 4.51%, but the 5-year average for Adobe was 17.63%. So there you have the main difference. Maybe we're going to get accelerated growth. Who knows? With all of the AI tailwinds, remains to be seen. Then with regards to valuation, as we previously seen before, it is not the cheapest out there. So that's why here they give it overall a D. If you look at PE non-GAAP forward, 30.89 compared to the sector median close to 25. But if you look at Adobe's 5-year average, it was more expensive before. Up next, company number 4, and I do think that this one will probably make some people angry, but that's fine. It's part of the channel. Like I said, every company can enter the portfolio. And remember, it's only long positions and I can trade. So company number 4 is a company called Alibaba. Oh my God, you bought a Chinese company. How can you do that? Yes, I bought Alibaba. I bought Baba stock at $72.32. I only bought 50 shares. This is only 3.77% of the portfolio. Why did I do that? Well, if you look at this, you cannot tell me that this is a huge bargain. If I remove the China part of things, of course, everybody would be jumping on this. But we cannot just remove the China risk from that. So I understand why some people would not want to buy this stock. I completely understand. But like I said, I'm looking here for outperformance. And I do think that I can find some outperformance with Alibaba at $72. Forward PE, 9 times. EV to EBITDA, 5.3 times. Price to sales, 1.4 times. Price to free cash flow, just 8.8 times. And a peg here of 1.05. Alibaba has a market cap of $190.42 billion. So yeah, I mean, it's very difficult not to add that right now to that portfolio. And although I know I don't directly own the shares outstanding have come down, free cash flow per share has gone up throughout the years. You're getting more buybacks now. You're also getting, by the way, a dividend. So I guess there is that. Plus, if you look at Alibaba's business, yes, overall total revenue only increased 6%. And yes, it's true, their cloud side of things is not really growing that fast, only grew 3% here in the latest report. But you're getting a company that is still one of the strongest companies out there. If you want exposure to things that are not in the United States or in Europe, then you have to go to China, where people have had great success with the likes of Pinduoduo, for example. I believe last year that stock was up 80%. So there's definitely some investors that are willing to buy Chinese companies. Of course, Pinduoduo provides a lot of growth, and that's why you've seen it outperform last year. Alibaba, not so much. But overall, you're buying here, in my opinion, quite a great company at a fair price. And yes, maybe you might say this is an homage to the late great Charlie Munger. If we go and look at Alibaba's profile here with regards to profitability, growth, and valuation, for profitability, they get an A+. So gross profit margin, C+, because it now sits at around 38% compared to the sector median of 35.6%. But the 5-year average for Alibaba sat at 41%. Of course, we know Alibaba can do better. But overall, EBIT margin, EBITDA margin, net income margin are quite good. If we look at growth, it's not the same growth company as we've seen before. Of course, if you look at the 5-year average, that includes the huge boost that it had a couple of years ago. Then after that, you had huge lockdowns, super long lockdowns, and they definitely took a hit. Remember, Alibaba also operates outside, Alibaba International, AliExpress, Lazada, the one in Turkey, Trendyol, etc., etc. Take all of that into consideration, plus the increased competition from the likes of Temu. Then last one, with regards to valuation, gets here a B. My opinion should be an A+. PE non-GAAP here 8.7, P-GAAP forward 13.46, lower than the sector median and much lower than the 5-year average. Moving on to the last one, company number 5 in that portfolio. That's a company I added more recently because of the earnings reaction, and that's actually Palo Alto Network. Now, Palo Alto, I added right here at around $274.55. I only added 10 shares. It's now 2.8% of the portfolio. This one I started very, very small because I'm starting to learn a bit more about that company and about their competitors such as CrowdStrike, SentinelOne, Checkpoint, etc., etc. So I'm starting very, very small despite the stock taking a huge hit. Remember, just because a stock takes a huge hit after earnings does not automatically make it a buy. Usually there is a reason why a stock crashes 20-25%. I'm going to talk about the reason. Maybe I'll do a completely separate video focused on cybersecurity stocks once maybe CrowdStrike has reported their own earnings report as well and compare both companies. But currently, Palo Alto Network, market cap $91 billion, forward PE 50.9 times. Before the earnings was closer to its mean at 65 times, so definitely not on the cheap side. By the way, its performance since last year is up 50%, so quite nice performance. EV to EBITDA 34.8 times, price to sales 10.8 times, price to free cash flow 31.2 times. Again, not cheap at all, which is also why it's only 2.8% of the portfolio right now. Now, the quarter itself was quite good. The quarter itself was good. The numbers looked good as well. The problem here was what happens next. What was guidance? Guidance did not meet expectations at all. Why is that? Well, because of this term right here, platformization. Basically, they're changing a bit of the way that they operate as a company, the way sales will work for them. The market, of course, doesn't like uncertainties. How will this affect forward numbers? How will this affect growth, profitability of the business, etc., etc.? Lots of question marks. The market acted accordingly. And so if we look at guidance, total billings of $2.3 to $2.35 billion, and then for the full year 2024, only $10.10 to $10.20 billion, a complete miss in expectations. So again, the stock crashed for a good reason. Besides, the moves towards what they called platformatization or whatever the name is called could very well work, right? Offering one full solutions for all your cyber needs could very well work. But of course, at first they're going to take a hit, and they're willing to take a hit because to attract more and more clients, that client has to cancel its contract, wait until that contract is over, and then hop on and be a client for Palo Alto. Use our services for free at first, but become our client. And so taking a hit in the short term for long-term gains could be the good strategy. Could also completely backfire. Remains to be seen. That's also why it's just a small position right now. It's a starter position, shall I say, still digging into this company and that sector. But right now, if you look at profitability, for example, it gets an A+, gross profit margin, A-, EBIT margin, EBITDA margin, net income margin, B+, B, and A+, compared to the sector, great company. If we look at growth, currently sits at B+. Of course, if for whatever reason it does not work out right now, growth will be impacted in the future. And so a B+ might become a C or a D, or maybe even worse, an F. Then looking at valuation, gets a D- here. We've talked about valuation at the start. Of course, not the cheapest one out there, especially not if you look at the sector median. It is a bit cheaper than the 5-year average, but overall, I do agree that right now valuation, it is quite expensive, especially with them transitioning now to a different type of execution. So overall, that's it. That's the first episode. You know the rules, you know the challenge. You know the portfolio right now. And by the way, if you're interested, these are the companies that are on my watch list right now. Some of them are yet to report latest earnings report. Maybe that will be a buy or a not to buy reason. But overall, this is the portfolio. Currently, we are actually up. We are actually up $700 since we started. So, okay, we are not losing money just yet. But the goal here is to beat the market. We'll see what happens. I'll do a recap every 2 weeks. So if you're interested in following this journey, do make sure to hit that subscribe button. It's free. You can always unsubscribe later on. And of course, this will always remain free for all. No paywall, no member, no Patreon, no whatever. Of course, if you want to support me, there are some links down in the description below. But overall, that's it. First video, very long, I know, but hopefully extremely informative for you guys. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.